Well, we've sort of attacked what you do yourself, and you develop skills that people are willing to pay for in the future, regardless of what the unit of exchange is. But in terms of inflation in our own businesses,
like Warren said here, the inflation of today is just like the one we saw in 1943. It's a harsh reality that we are running out of resources and inflation is eating us up, with prices for daily necessities skyrocketing each day and money disappearing into thin air. What do you do when inflation rises? You develop skills that you are good at and we invest. In a world swirling with economic uncertainties, where the tides of inflation relentlessly sweep over the financial landscape, there exists a quest for a treasure trove of wisdom, the best investment you can make during inflation. As the global economy teeters on the edge, and the value of currency seems to fluctuate like a whimsical dance, people who seek financial security are drawn to investing strategies that could help them combat this high inflation period. Warren once said, "Economic medicine that was previously meted out by the cupful has been recently dispensed by the barrel." These once unthinkable dosages will almost certainly bring on unwelcome after effects. Their precise nature is anyone's guess, though one likely consequence is an onslaught of inflation. According to Buffett, bonds, dividend-paying stocks, and diversification are some essential tools you can use to fight this war against inflation. However, before you dive into the intricacies of economic inflation, you need to wrap your head around the concept of inflation. So what exactly is it? To put it into simple words, inflation is a disease that erodes the purchasing power of money. It's like walking to your favorite lemonade stall in the heat with a crisp $10 bill in your hand. You know that you're going to treat yourself today. But when you reach the stall, you see an extra $5 added to the amount that it previously took you to buy a fresh glass of lemonade. This is called inflation, except that it impacts the economy worldwide. This means that your hard-earned cash won't stretch for as long as it used to.
We've kept buying things, and we don't make stock market guesses, and we don't know how to profit by looking at broad statistics and guessing what stock markets or bond markets will do.
But you have said that you do pay attention to interest rates, and that interest rates are like gravity.
The price tags on goods and services increase and businesses suffer drastically. Like Buffett said in this video, sometimes investment doesn't rely on data and statistics. Sometimes the right investment can make or break you and your financial state. The reason why the economy rears its head towards inflation is an increase in the money supply. Where there is more money circulating in the economy, prices of goods and services spike, raising production costs. Increased demand for goods can also contribute to inflation. But there is one more thing that claps a welcome to inflation, and that is global events. For instance, the Russian invasion of Ukraine can immensely contribute to rising inflation. It makes no difference to a widow with her savings in a 5% passbook account whether she pays 100% income tax on her interest income during a period of zero inflation or pays no income tax during years of 5% inflation. Either way, she is taxed in a manner that leaves her no real income whatsoever. Any money she spends comes right out of the capital. She would find outrageous 100% income tax, but doesn't seem to notice that 5% inflation is the economic equivalent. Just like Buffett mentioned here, the consequences of inflation can be devastating. It decreases the value of your savings and can heavily disrupt the business landscape. The question is, what should we do in a time of high inflation like now? One thing that you should realize in such times is that the traditional mainstream methods of investment may not work and profit in times like these. When the prices are spiraling upwards, you need to adapt. Dealing with inflation is no easy feat, and neither is it a walk in the park. It demands your attention and prepares you to adapt and learn better ways of investing and profiting from your existing money. This is how you can make the best investments during inflation. Warren Buffett is known for his investment expertise and tricks. He believes in the long-term value investing approach. According to him, any easy money or quick investments are not really something that is going to help you in the inflation periods. He once said, "You don't need to be an expert in order to achieve satisfactory investment returns. But if you aren't, you must recognize your limitations and follow a course certain to work reasonably well. Keep things simple and don't swing for the fences. When promised quick profits, respond with a quick no."
What's going to happen in a day or a week or a month or a year even? I'd never felt that I knew it, and I've never felt it was important. We're almost always a buyer of stocks.
What he said here is cruelly very true. Buffett managed to make even the most experienced investors envious of his success. And how he managed to do it lies in his discipline and instincts. He contrived to place his goals in the long-term approach rather than focusing on the fluctuating market. In simple words, he never let the flashy investment trends sway him from his objective. It's all about keeping our eyes on the big picture, focusing on what lies ahead, and preparing for what's coming. Like he said, we are in effect making a choice between future inflation and getting off the floor. We're likely to have more inflation in the future as a consequence of the things we do to fight the present situation. This is also a very big reason why Warren Buffett investment philosophy can help you make better use of money during inflation.
Well, the answer is I do believe in dividends in a great many situations, including many of the ones, companies in which we own stock. The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain.
Dividend-paying, bonds, and tangible assets are great tools to combat inflation. When there is an inflation monster lurking around, you need to invest more wisely. According to Warren Buffett, one of the most effective ways to keep earning during inflation is to invest in tangible assets. Investing in assets like real estate, commodities, and precious metals is a great idea since they tend to hold their value. They are like anchors who can help you navigate through the era of decaying economy. According to Warren Buffett, inflation acts as a gigantic corporate tapeworm. That tapeworm preemptively consumes its requisite daily diet of investment dollars regardless of the health of the host organism. Regardless of a company's profits, it has to spend more on receivables, inventory, and fixed assets to simply equal the unit volume of the previous year. Another important thing is realizing the power of pricing. You need to invest in companies that can up their prices and profit regardless of the eroding economy. Investing in dividend-paying stocks is also a great way to get a steady stream of income that doesn't really halt because of the inflation. Dividend-paying stocks are shares of companies that distribute a portion of their profits to shareholders in the form of dividends. These stocks offer an advantage during inflationary periods because companies often raise their dividend payouts in response to their rising prices, providing investors with a relatively stable income stream. Additionally, well-established companies with consistent dividends tend to be more resilient during economic downturns. By holding dividend-paying stocks, investors can potentially offset the eroding purchasing power of their money caused by inflation. Bonds, especially inflation-indexed bonds, are another valuable tool for inflation-proof vesting. Inflation-index bonds, like Treasury Inflation-Protected Securities, or TIPS, adjust their principal value in response to changes in the Consumer Price Index. As inflation rises, the principal value of these bonds increases, and the interest payments also grow. This ensures that bondholders receive a return that is adjusted for inflation, effectively safeguarding their investment from the erosion of purchasing power. Inflation protection securities are specifically designed to provide investors with a hedge against inflation. These securities can include commodities like gold, real estate investment trusts, and certain exchange-traded funds that invest in inflation-sensitive assets. Gold, for example, is often seen as a safe haven during inflationary times, as its value tends to rise when the value of fiat currencies declines.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing.
Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market.
As Warren mentioned here, diversification is a crucial aspect of inflation-proof investing. By combining dividend-paying stocks, bonds, and inflation protection securities in a well-balanced portfolio, investors can spread their risk and potentially achieve better overall returns during inflationary periods. It's important to note that while these investment instruments can mitigate the impact of inflation, no investment is entirely risk-free, and investors should carefully assess their risk tolerance and financial goals. In Buffett's words, diversification is protection against ignorance. It makes little sense if you know what you are doing. Have you heard the saying, "Don't put all your eggs in one basket"? Well, the very same thing applies to investing, especially during inflationary periods. By diversifying, you are making sure that your money is well distributed and safe when the market fluctuates. It's like having your own personal team of super soldiers, each with a unique ability and value. One can do what the other cannot. According to Buffett, the biggest thing you'll learn is that the pandemic was bound to occur, and this isn't the worst one that's imaginable at all. Society has a terrible time preparing for things that are remote, but are possible and will occur sooner or later. Preparing for inflation comes with understanding the magic of the business's pricing power. The ability of businesses to raise prices for their products and services in response to growing costs while still remaining profitable is referred to as their pricing power during inflation. Consumers' purchasing power may decrease due to inflation, which would increase the cost of labor, transportation, and other corporate inputs. Strong pricing power gives businesses the freedom to pass on these rising expenses to customers without really materially affecting demand for their goods or services. Investors who want to make wise judgments during inflation periods must comprehend and analyze a company's pricing. Companies with a solid reputation for their brands and a committed consumer base frequently have more pricing power. Even when the costs increase, consumers are more prepared to pay extra for goods or services offered by reputable, well-known companies. Additionally, businesses that provide distinctive or differentiating goods that are difficult for rivals to imitate can charge higher costs without losing market share. Companies that operate in sectors with high entry barriers or little competition can also keep pricing power during inflation. In these sectors, firms have more power over pricing decisions because there are fewer rival providers and fewer consumer options. Additionally, businesses with long-term agreements or subscription-based business models may profit from consistent income streams despite inflationary pressures. These companies might be in telecommunications, utility, or software-as-a-service industries. They can lessen the effects of growing prices and maintain profitability by securing clients with fixed-rate contracts. On the other side, businesses with poor purchasing power could struggle when there is inflation. It may be difficult for businesses to raise prices without losing customers in highly competitive markets, especially when consumers can readily switch to less expensive competitors. Similarly to this, businesses with inadequate distinction or low brand loyalty may be more subject to customer price sensitivity. When building an inflation-resistant portfolio, investors must consider a company's pricing power. Companies are more likely to surpass their peers if they can increase prices while maintaining profitability. To effectively assess a company's pricing power, investors should take into account elements like brand strength, industry dynamics, the competitive landscape, and customer behavior.